Hey, good morning, everybody. It's Monday, March 23rd, 2026. I've blew out my voice on that one. I, of course, am Hammer, founder of Hammer Solutions, home of great products such as Originator Success, Grab and Go Social, and Rate Sensei. All products here to help you to get more business in 2026 and navigate a very difficult market at the beginning of the year that we're dealing with here in March. So anyway, remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. So glad to have you here. If you're here this morning, say good morning. If you're watching on the replay, don't forget, just give me hashtag replay in the comments. Let me know that you were here, but you really should join us live. And if you don't want to miss any of the show, make sure you sign up for our text reminder. Goes out each day as I'm starting to go live. As I hit that button, I send out a text reminder. It's got the links to the show. We don't use your information for anything nefarious. We don't sell it. We don't trigger lead it. We don't do anything. So you can go ahead and sign up for those for free, hmmr.io/reminder, or get this cool QR code over here, just so you don't miss a moment of the show. So glad to have you all here. If you're here this morning, say good morning. Let me know that you were here. Welcome to all the live folks. Brendy Brickler, Holly Johnson. Good to see you all. Hope you had a good weekend. Nicole Semerad, Ron Siegel. Today is National Chip and Dip Day. Today is National Chip and Dip Day. So our question of the day, of course, is what is your favorite chip? What is your favorite chip and dip combo? So that is the question of the day. Thank you, Mr. Ron Siegel. Appreciate you. So if you're here this morning, make sure that you answer. We'll come back at the end and take a look at your answers. What is your favorite chip and dip combo? So good morning, Christy. Good morning, Tim Kyla, Rob Wilson, Angela Walters, Robin Davis. Good morning, Tom Deadmore, Greta Cheney, Sarah Fuller. Great to have you here. Matt Rasner. Good morning, all. So many of you here this morning. Appreciate you. Hope you all had a good weekend. Don't forget, go ahead and answer. What is your favorite chip and dip combo? I'm going with Tostitos and quesadilla, the orange queso. I like that stuff. It's probably terrible for you. There's probably nothing natural in there, but I do like it. It does taste good. So that's mine. Go ahead and give us your answer, and we will get to it. So in the meantime, let's go ahead and jump into the good stuff here. Let's get started. Pull this up here. All right. So first and foremost, let's go ahead and do a quick recap of what happened on Friday. Friday is everything in front of this dotted line right here. In order to put Friday in perspective, though, we've got to put it on the 5-day chart. Take a look here. Friday is everything in front of, or between rather, these two yellow lines. Friday, we started the day with losses. You can see that right here. Bonds had already moved down on the day, and then down got ugly. Bonds sold off, and it was brutal. It was so brutal. It was from bad to worse to, oh, the hell with it, I'm going home. We lost 87 basis points on Friday. Friday was a brutally rough day. Quick recap. We lost ground early. Again, you could see that here in the 5-day. You could see that we ended on Thursday. We ended at 99 basically. And then by the time we got to the open here, it was already down 30 basis points. And then it just got worse as we were on the live. By the time pricing came out, we were close to the lowest levels of the day, but not quite. By the time pricing came out, lenders were down 98, 20, we were down 60, 70 basis points by the time lenders started coming out with pricing. We saw a little bit of improvement as there was basically some, repositioning, and then bonds ended the day even lower, down almost 90 basis points on the day. That was enough of a move, even from that point, that we saw quite a few reprices worse. If you look here using MBS Live and different user reported reprices worse, there were a lot of lenders that still went from bad to worse on Friday. And we ended the day on Friday. It really, our text alert was probably not the best one that we could give you. You can sign up for our text alerts at www.ratetextalerts.com. We send out a morning alert, as we did here. and then an afternoon alert, and when there's a risk of reprice. However, we didn't send out reprice worse because there were just so many odd things going on. It didn't matter, and we had said that we were going to go through it. So yesterday, or Friday rather, we said today is a full-on face-melting sell-off with bonds getting worse by the minute. Can't blame this one on Powell or even oil. It's just pure panic. Rate sheets are going to be much worse, likely about a quarter point in rate worse. Now, according to Mortgage News Daily, it wasn't quite that bad, though. And according to Mortgage News Daily, there was only a move of about an eighth of a point in rate. I'm surprised by that. I think it was bigger than that. How much of a jump did you guys see in your rate sheets? Let me know in the comments, please. How much of a jump did you see in rate sheets? I think that, I mean, come on, when you see an 70, 80 basis point move, you're looking at a quarter point difference in price. But anyway, no point in locking right now. It's like putting a seatbelt on after hitting a tree. Hold off and hope for some kind of recovery, but it could get worse and we might have to lock. Ugh. However, at the end of the day message, we were down. It was about 15 basis points from when the morning came out, right? Well, bad turned to worse today as bonds continued selling off. Usually after an ugly sell-off like this, we see some kind of recovery, but nothing is guaranteed in this volatility. Tough decision on whether to lock or float. Really no good answer. Any recovery in bonds is sure to be short-lived and probably won't help rate sheets too much. Rates are likely to move up over the coming weeks. Now, let's talk about that. So, where did that bring us and what happened next? Again, sign up for our text alerts at www.ratetextalerts.com where you use this cool QR code. But where did we go from there and what happened? Well, things got crazy over the weekend. As President Trump tends to do, he made a tweet, a social media post, a Truth Social post, his preferred and owned platform, that if the U.S. would obliterate, hold on, I gotta find it. That the U.S. would obliterate the energy, the power plants in Iran, if that regime didn't reopen the Strait of Hormuz within 48 hours. And 48 hours put them into Monday evening. So this was issued on Saturday, and that was then popped over to here. So let's see if oh, look at this. We do not want this ad. Get rid of this. I don't need that. I'm looking to see. I don't use Truth Social, so I don't know. All right. I'm not going to bother with it. I'm just going to go back to where we were. So anyway, taking a look here, that was the original thing. And then what would have happened if that had been the case, if we would have seen continued concern? Let's get those headlines. Trump attack and power plants. Let's just see like what the headlines were, so if we had struck power plants, there's talk over the legality, which I don't understand how you can have war and rules to war and legality to war. But anyway, there was talk about that. It would have been a thing, right? So, however, if that would happen, we were going to see this morning, we would have absolutely have seen bonds take a bath. The 10-year Treasury yield was already up to, I think, 4.44 was what it was up to. It's at 4.35 at the moment. You can see right here. I think it was all the way up to 4.44. It was definitely a situation that would have escalated and led to more negative rate sheet pricing. Instead, we basically averted that with this tweet that Trump came out with this morning. It was 7:23 a.m. Eastern time this morning. I'm pleased to report the United States of America, the country of Iran, have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East. Now, a couple of things here. As was the case last time, Iran is saying, no, we didn't. We don't. We haven't been negotiating at all. I think they're both lying. I think there's a little bit of embellishment from each side. I'm sure that the last 2 days have not been very good and productive conversations, but there's probably been some conversations. I can't imagine that Iran is sitting back thinking that they're really going to outlast the United States and that they're going to win this situation in a economic fashion rather than a military one. But that is their current tact. That's the direction they're taking. However, this led to, based on the tenor and tone of these in-depth, detailed, and constructive conversations, which will continue throughout the week, I have instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period. But subject to the success of the ongoing meetings and discussions. Now, remember, I don't want to get into a whole, whether he's right or wrong or taco or how Trump operates, but Trump will, his MO, he did it on a Saturday. He put out this whole thing that there was going to be a major thing. He ratcheted it up, right? Then he says, okay, we've got, this is part of his art of the deal, negotiating. It's what he's done from day one. Anybody that watches his negotiation style, this is what he does. And of course he embellishes and sometimes just flat out lies and creates, so we may not be having any great conversation. We may not be close to a resolution at all. If we are close to a resolution and things were to see a ceasefire, you would see oil start to improve. And again, it's really going to come down to how many ships truly are making it through the Strait of Hormuz. I read somewhere that last week, 7 ships made it through instead of something like 100 that normally would make it through. If we see a true resolution, we will see rate sheets start to recover. How much recovery will we see? Well, that's a great question, because the longer this continues, the more of an effect it's going to have on oil prices and the inability for them to continue to move lower. The attacks from Iran onto Qatar facilities that were owned by Shell, which is a UK company, but Shell, it's liquid natural gas that they produce, and this, they're talking it'll take a year to bring it back online. This was a $20 billion facility, state of the art, recently opened, $20 billion, and it was damaged during attacks from Iran. And that's going to have a lasting effect. They're saying it could take up to 5 years for some things to be restored to normal. That it's like here in North Carolina after the hurricane. It's going to have a longer term effect. The longer this continues, the more of an effect. So rate sheets today, though, could show some small recovery. If you take a look, and again, I want to see what you guys said. Where did I think that we would have seen rates go up at least a quarter. Hello, we went up 90 basis points. That's a quarter point minimum for rate jump. According to Mortgage News Daily, we went from 6.43 to 6.53. That's barely an eighth. How much did you see rates move up? I'm looking to see what you guys said previously when I asked this. How much did you see rates move up during that time? We'll come back to your chips and dips answer. Make sure you're answering that down at the bottom. We're going to hit those at the end. Good morning, Zane. Hola from España. Oh, hello, Gay. I hope you have a fantastic trip. Ron Siegel said, I think I heard somewhere the markets always overreact. I have a friend that talks about that, Ron. I should introduce you. POTUS called into mornings with Maria, and everything changed about 9:30 a.m. Pacific time today. Trump not telling the truth. I'm shocked. Yeah. And again, I don't want to get into too much of the throwing mud or supporting or not supporting or whatever. But you look at the whole reality here, right? So we're trying to figure out, where is this actually going? What effect will it have? What is it having on rate sheets? So tell me, y'all. I don't see anybody that answered me. How much did you guys see rates go up on Friday? It was a brutal, ugly day. So, but as far as we go this morning, you take a look at oil prices. Oil was up to $112 a barrel on Friday, and it's back down to 102.61. So that's why you're seeing, it's not the only reason, but it contributes to all of why we're seeing that improvement in mortgage bonds. They're up 17 basis points. When you've lost 87, that would still put us down 70 basis points on the day, kind of where we were at the beginning, right here when we did the show on Friday. I mean, that's really not an amazing recovery, but it is a recovery, and it's better than what we were looking at as an alternative, which was getting our butts kicked for based on where things were going. Now, reprice risk on the day is high. If Trump walks back that 5-day window, markets will melt down again. If he says that Iran is not negotiating in good faith, if there is some kind of Iranian attack that he has to justify, arguing against, again, I'm not here to attack Trump. We're talking about how does this all play out and why? And you got to be realistic. So I don't care about political leanings. Again, I'm not one way or the other. I vacillate with the wind. I really don't care. What we're looking at is what is this going to do? Now, the 10-year Treasury yield, 4.34. Again, that is much, much higher than the 3.94 we were at just at the beginning of March, at the end of February here. Before this whole Iran situation erupted, you're talking a 40 basis point swing there for the 10-year Treasury yield. However, it could easily go back up into the 4.4s or even 4.5 if we see more escalation over in Iran. That would, of course, trickle over to the rest of the bond side. Now, the other thing to keep in mind is that the outlook from the Fed has dramatically changed. We went from, in April, right? You now have, it still remains that markets don't expect to see any kind of rate cut. They expect rates to remain the same in the April meeting 6 weeks from now at about 92%. But instead of any possibility from a rate cut, which should be on this side over here, we see the possibility of a rate hike. And that is not just what happened after the Fed meeting, but it's also because of what's happening in global markets and central banks in Europe and even in Asia, like, what expectations are, Bank of Japan and things like that. So this is big, big, big difference. And if we compare that to where we were, a month ago, there was a 20% expectation we could see a rate cut in the next meeting. And now there's an expectation we could see a rate hike. When we get to the end of the year, that's where you really see the biggest difference. Look at all of these light blue lines to the left. This is where, if we see things remain the same with no rate cuts, but no rate hikes, markets are now pricing in the chance of a rate hike at about 30%. You can see that here. Minimum of one hike. This would even be two hikes or a half a point hike, right? Look at this. We were at a 40% expectation of a single rate cut just a couple of weeks ago. And now that is gone almost altogether. There is barely less than 10% expectation we could see a rate cut this year. Markets have given up on the idea of a rate cut from the Fed, have now started to price in the possibility of rate hikes from the Fed. That's going to make it very, very difficult for Warsh. And that's an interesting article. Let's see. There's an interesting article here in the Wall Street Journal about Warsh taking over. So the Fed's most awkward leadership transition is coming. Kevin Warsh promised to overhaul the central bank and cut rates. He's being greeted by rising inflation, an oil shock, and a confirmation in limbo. Now, remember something. Warsh can't just sweep in and save the day and start cutting rates. He would be the Fed chair. He would have tremendous influence, but it is still a Federal Open Market Committee, right? So you still have all the other Fed members. There's 19 Fed members, but only, I think 9 votes. I'd have to double check it, but not all of them vote every year. The governors vote, and some of the New York's Fed president votes every year, and then some of the other ones are on a round robin. So anyway, he would have to convince all them that this is the case, and that's why we saw such a negative reaction when the Fed meeting happened. It was much more negative, much more effect on markets than I expected. That was this red candlestick you see right here. And that was because markets were not expecting the Fed to come in swinging, talking about rate hikes. And that was even though it was only mentioned, it was very hawkish statements that based on the condition that inflation is not moving lower like the Fed wants to see, they're disappointed in how it's moving. And this, oil, all of that is going to cause inflation. Even if you take the core, which takes energy inflation out, it still has a rippling effect through the rest of goods and prices into the economy. So Ron Siegel said, I'm not giving a May 10th Barry moment, but I might circle June 17th for a rate cut. You really think so, though? I don't think so. I don't think that he would have anywhere near the pull. And especially Ron, I think that with the idea that the way he has attacked the Fed and gone after Powell, I think they're circling the wagons. I think they're going to freeze him out. He'll get a little bit of support from Waller and from Mickey Bowman, but that's it. I don't think he's going to get support from anyone else. And you're making fun of me about the Fed and the Fed being political. I know we are. Yes, I go both ways. You can have fun with that one. Take a stab at that line. I'll give you that one. I set myself up for it. If you want great info about what is happening and why, podcasts have the best info. Former CIA operative Mike Baker and the president's daily briefing. It's not political, but he discusses what's happening from the intelligence perspective. Thanks for sharing that, Ron. Appreciate that. It's good to know. So, all right, everybody. Well, let's have some fun. I will put for lock advice, by the way, I haven't really done a great job of answering that for you. Lock advice, you were cautiously floating. We want to see how long can we hold on to these gains that we're seeing right now, currently up 25 basis points. We want to see which direction things go. If markets buy into the idea that we could be close to a resolution, that things are moving in the right direction, that we could get ships through the Strait of Hormuz, that there might be some de-escalation to the military action in the Middle East, then that is going to help bonds improve and will help rate sheets improve. We're not going to go back to 599 anytime soon, I can tell you that, but we could see some improvement. It's very cautiously floating, though. Be ready to lock. And remember, it's very difficult to forecast what's going to happen because it's very reactionary to the price of oil, what's happening in the military scenario out in the Middle East, everything like that. So keep that in mind. But otherwise, let's have some fun now. Something a little lighter. What is your favorite chip and dip combo? If you haven't answered yet, let me know in the comments. Let's go ahead and take a look. Rob Wilson's going with tortilla chips and queso. Brandy Brickler, Doritos and sour cream and onion dip. But I gotta get it. Ruffles and homemade French onion dip. Zane, I don't know if you answered. Make sure you answer. Wavy chips with pickle dip. Pickle, I'm like a dill pickle. Tortilla chips and salsa. Angela, you going with a mild salsa, a medium salsa, or a hot salsa? I'm a medium salsa guy. Ron Siegel also Ruffles with sour cream and onion dip. However, if you look at Ron's physique, I don't think Ron has had Ruffles in quite a while. He has lost a tremendous amount of weight and looking fit and healthy. So good for you, Ron. Keep it up, man. Jeremy needs some great news. Jeremy, the great news I have for you is that there are chips and dip combos like crazy. That's the great news that we have. Actually, it is great news that we didn't see the markets get tanked this morning. Being up 25 basis points qualifies for great news. Holly had a colonoscopy on Friday. Well, yeah, it was a good day for that. It was all your fault that everything went wrong. Ron said the first time he's ever heard a colonoscopy was better than a day in the market. Yeah, it was better than the mortgage business, right? Kelly likes chips and Tex-Mex queso. Fritos and bean dip. I haven't heard that one yet. That is, I do love me some Fritos. Good old corn chips and bean dip. Good morning, Segaloff. We're talking about it. Angela's got that. You're from Utah. You think you're from Texas with that. The medium and hot for the salsa. Not too hot, though, she says. Not too hot. So, all right, my friends. Well, I'm going to wrap it up. Thank you again for joining me. Tomorrow, we'll be talking about the same thing we talked about today. There's really nothing on the economic calendar that's going to have any effect this week. It's really all about the escalation in Iran, what's going on in the Middle East, what's going on with oil prices. There's not a lot of expectation that rates will improve much this week, but maybe go up at a slower extent. Buffalo chicken dip with tortilla chips. That's a good one. That's a good one. I'm with y'all. I like buffalo chicken dip. I've had that before. But then I also want blue cheese. So, all right. I'll see you guys tomorrow. Take care, everybody. Have a fantastic day. Thanks again. And let's keep our fingers crossed that rate sheets will reflect this morning's improvement and that those improvements will hold heading into tomorrow, maybe even, build from that. There's not a lot of reason to expect it. A lot of what we are seeing today, I'll end on this real quick and then I'll wrap up. But a lot of what we are seeing here is after you see a sell-off of 87 basis points, generally the next trading session, you're going to see some profit taking. You're going to see some repositioning. And that's a lot of what this is. But there's also a bit of a relief rally in here. The relief rally being that the situation here, hold on, why I don't have Trump sticks with talks claim after Iranian denials. So this one is U.S. says it held good talks with Iran. Iran media denies negotiations have taken place. Again, I think there's a little bit of lying on each side. I think they probably are, negotiating. I don't think the talks were as good as he says. Trump issued a 48-hour ultimatum for Iran to fully. That was before the whole thing, so they're kind of going backwards on this one. Trump rebuffs Iran talks denial, says envoy spoke last night. So, again, I expect to see more of this back and forth. That's why we have to be careful. Things could turn around, but overall, this is kind of, we'll see where this goes. It's a bit of a relief rally because we're not seeing more escalation in military action and hoping to see the Strait of Hormuz get opened. So, all right, I'll catch y'all later. Have a fantastic day, my friends. I'll see you tomorrow. Take care, everybody. Bye-bye.